You are listening to The Vocal Technologist. Spoken Tech for your ears.
What if your spreadsheet could actually think for itself?
Right.
And your social media app held your mortgage and the traditional stock market, never actually closed.
Yeah, it sounds like pure science fiction or, maybe just a highly chaotic fever dream.
Exactly.
But the fascinating thing is, it is literally the reality being built right now.
Look, you are a smart professional, probably incredibly time poor, and keeping track of how money is fundamentally changing is practically a full-time job.
It really is.
You want the insights without getting bogged down in endless technical papers. So we have been digging through a massive stack of research notes, market reports, and SEC filings to look under the hood of the converging worlds of finance, artificial intelligence, and blockchain.
We're going to unpack how money is being completely rewired.
And I am bringing that tech-savvy made energy to make sense of the complexity without the jargon. We're going to pull apart the actual mechanics of it all.
I am very much looking forward to getting into this because we are looking at a fundamental rewiring of financial infrastructure, and the speed of integration between these different sectors is genuinely unprecedented. The walls are just coming down.
Let us start with something that feels like a massive cultural pivot. Revolut securing a full United Kingdom banking license after a 4-year wait.
4 years. That is a lifetime in tech.
It's a nightmare.
Yeah.
And this is not just a digital wallet anymore. They can now offer loans, mortgages, credit cards, overdrafts, and insured savings through the Financial Services Compensation Scheme.
Which is huge.
They currently have 13 million United Kingdom customers and 70 million globally. And they are targeting 100 million.
That is a staggering user base. And what is crucial to understand here is the broader trend. Revolut is not an isolated case.
Right.
Neobanks like Bunk, Nubank, and PayPal, along with major crypto firms like Circle, Kraken, and Ripple, they are all aggressively pursuing United States banking charters.
I am looking at these wait times, though. 4 years for a piece of paper sounds like torture for a fast-moving tech company.
Oh, absolutely.
To me, that says they are desperate to cut out the middleman sponsor banks so they actually own the payment rails. I reckon that has to be the primary driver here, right?
That is exactly the mechanism at play. It comes down to gaining direct control over the financial infrastructure.
Because before this, they were just renting it.
Spot on. Historically, fintechs operated on what we call a partner bank model. They were essentially the shiny user interface layered over a traditional, often sluggish, sponsor bank.
Right, so the fintech builds the beautiful app, but they're relying on the plumbing from some small regional bank.
Precisely. And the problem with that model is third-party risk.
Oh, yeah.
If your sponsor bank runs into compliance issues, or if regulators decide the sponsor bank is taking on too much risk, your shiny app suddenly stops working.
Wow. Your customer just cannot access their money.
Which is fatal for a financial app. So by getting their own charters, these companies gain direct access to the payment rails. They control the entire stack.
From the user interface all the way down to the central bank reserves?
Exactly. They are no longer asking permission to move money.
It is genuinely amusing when you step back and look at it. The exact fintechs that were built specifically to disrupt and destroy traditional banks are now eagerly filling out mountains of paperwork to become them.
Yeah, it is full-on irony.
It is like the school rebel finally demanding the keys to the principal's office so they can enforce the dress code.
The rebels realize that to actually change the system, you cannot just throw rocks from the outside. You have to own the plumbing.
But controlling the banking licenses is completely useless if the actual payment rails are still stuck in the 1970s.
Which they are.
That is why these same companies are tearing up the floorboards and replacing the old clearinghouses with entirely new infrastructure.
The plumbing is getting a massive upgrade, and we are seeing traditional finance merging directly with blockchain infrastructure.
Let us get into that.
Yeah.
NASDAQ is teaming up with Kraken's parent company Payward to use their xStocks platform. They were tokenizing equities to move them onto blockchain networks.
No.
And then you look at Stripe. Stripe hitting a $159 billion valuation.
Which is a 74% increase, by the way.
Insane growth. And they are pushing incredibly hard into crypto and agentic commerce.
Stripe's movements are incredibly telling about where the entire system is headed. They're not just processing credit cards anymore.
No, they acquired Bridge for $1.1 billion.
Yeah.
They bought Privy, and they are building Tempo, which is an L1 blockchain currently being tested by massive players like Visa, Nubank, and Klarna.
And do not forget MasterCard. They have signed 85 partners to a crypto program, including PayPal, Ripple, and SoFi.
It is a massive shift. But let me pause on this L1 blockchain detail. For the listener who hears that term and immediately tunes out, what actually is a Layer 1 blockchain and why is Stripe building one?
Think of a Layer 1 blockchain as the foundational highway system. It is the base architecture where the rules of the road are defined.
Where the actual concrete is poured.
Exactly. Bitcoin and Ethereum are Layer 1 blockchains. When Stripe builds Tempo as an L1, they are not just building a new type of car to drive on existing roads.
Right.
They are pouring their own concrete. They want to own the highway that global payments travel across because the traditional banking highways are too slow and expensive for the future they envision.
But let me push back on this whole concept of tokenization for a second. Is tokenizing an equity really that revolutionary? Or is it just putting a fancy digital wrapper on an old product?
It is way more than a wrapper.
I mean, is this just the financial equivalent of upgrading from physical mail to email, where the message is exactly the same, but the speed changes everything?
Your analogy of physical mail to email is actually a fantastic starting point, but we need to remember exactly how much email changed the world.
Fair point.
It was not just faster delivery. Email allowed for automated sorting, mass distribution, programmatic responses, and seamless integration with other digital systems.
Oh, I see where you're going with this.
Tokenizing an asset does the exact same thing for finance.
So it is not just about the speed, it is about what you can do with it once it is digital and programmable.
Exactly. Let us look at the mechanics. When you move an equity from a traditional clearinghouse to a blockchain, you are enabling always-on markets.
Because the traditional stock market closes on weekends and holidays.
Right. A tokenized market operates 24 hours a day, 7 days a week. But more importantly, you get significantly faster settlement times.
Which is huge, because the traditional system takes a couple of days to actually settle a trade, even if the app says it happened instantly.
We call that T+2, meaning trade date plus 2 days. During those 2 days, there is counterparty risk.
What if the buyer goes bankrupt before the money actually moves?
Exactly. Tokenization allows for practically instantaneous settlement. The asset and the payment swap simultaneously.
So nobody is left holding the bag.
Right. That removes a massive amount of counterparty risk from the system, which frees up trillions of dollars in capital that banks previously had to hold in reserve just in case a trade failed.
And it changes how the asset behaves, right?
Yes, it allows for entirely new forms of shareholder engagement. A token is essentially a piece of software. It is programmable money.
So you can embed rules right into the stock itself.
You can embed a smart contract into a tokenized stock. That stock could automatically distribute dividends the very second quarterly earnings are verified,
Routing fractional cents to millions of wallets instantly.
without needing an army of accountants to process the payments. It has its own built-in bouncer and accountant.
Okay, so the underlying plumbing is becoming lightning fast, digital native, and highly programmable.
Yes.
But once that infrastructure is in place, the natural next step is embedding those financial services directly into the platforms people already use every day.
Which is where it gets really interesting for the average user.
We are moving away from the concept of going to a bank or even opening a separate banking app. Finance becomes an invisible layer underneath your normal digital activities.
Which brings us directly to the race for the Everything app. The strategy is to capture the user's attention and never let them leave the ecosystem.
Like Elon Musk launching early public access for X Money. He is pushing to rival digital wallets like PayPal and Cash App entirely within a social ecosystem.
And it is happening on the business side, too.
Yeah, Airwallex launching Yield for United States businesses.
Yeah.
This allows companies to automatically sweep their idle cash into a JP Morgan government money market fund.
That concept of sweeping idle cash is fascinating because we need to understand the mechanics of what idle cash actually does.
Mostly nothing, right?
Historically, yes. This was a treasury management tactic reserved strictly for massive multinational corporations.
Let us break down what sweeping actually means for a regular business owner listening to this. How does it work in practice?
Basically, if a business gets paid $10,000 and that cash is just sitting in an operating account waiting to be used for payroll next month, it is actively losing value to inflation.
It is earning zero interest.
Sweeping automatically monitors that account. At the end of the day, it moves that uninvested money overnight into a secure, interest-bearing asset like a government money market fund.
So it earns interest while you sleep.
Then, the moment the business needs to make a payment or run payroll, the system automatically sweeps the exact required amount back into the operating account.
And Airwallex is embedding that complex treasury function directly into their platform for standard businesses. And the numbers are wild.
They really are.
Airwallex hit $1.2 billion in annual recurring revenue with 85% growth.
Which is a phenomenal growth rate at that scale.
Because they are handling these efficiencies, they saved their customers $1.3 billion in fees in a single 12-month period. And their yield product has already surpassed $1 billion in assets under administration globally.
It eradicates the concept of idle money. Every single cent is constantly working, constantly yielding a return.
Without the business owner having to lift a finger or hire a treasury team.
Exactly.
But let us be honest about what this means for our daily habits, because apparently that is where we are now. You will open an app to post a meme and accidentally apply for a business loan and sweep your idle cash into a money market fund.
It sounds absurd when you say it out loud, but the friction between human intention and financial transaction is completely disappearing.
Yeah, but there has to be a catch.
There is. A massive bottleneck emerges here.
The brainpower required to run it all.
Exactly. Managing all of this embedded financial complexity is staggering.
I mean, you have tokenized assets trading 24 hours a day.
Automatic treasury sweeps happening across thousands of accounts and complex cross-border payments settling instantly.
It requires significantly more analytical brainpower than is humanly possible to deploy at scale.
And that creates the absolute perfect opening for autonomous artificial intelligence.
We are moving way past using AI to write a polite email to a coworker.
Oh, heaps past that. AI is taking over complex financial and legal workflows. Analysts are calling this the Cursor moment for Excel.
For those who might not be familiar with the developer space, Cursor is an AI coding assistant. But it does not just suggest the next line of code like a glorified autocomplete.
No, it can understand entire software architectures and build them out based on high-level instructions.
So a Cursor moment for Excel implies a massive leap from simple formatting to genuine financial reasoning.
It means the AI is doing the heavy lifting of building the financial architecture.
We are seeing this play out right now. Hedge fund analyst Brett Cochran have been testing models like GPT 5.4 thinking.
And the results are wild.
These models can now actually analyze spreadsheets well enough to handle real investment workflows.
Imagine what an analyst normally does, spending hours pulling SEC filings, copying the data into Excel, and building a discounted cash flow model.
Now that AI does that grunt work.
Then you have Microsoft Copilot Cowork acting as an autonomous agent across Outlook, Teams, and Excel.
It uses Anthropic's Claude model to plan workflows and prepare customer pitch decks completely in the background.
This represents the critical transition from conversational AI to agentic AI.
Let us unpack that distinction, because I think a lot of people still view AI purely as a chatbot.
A conversational AI is essentially a search engine on steroids. You ask it a question, it gives you an answer, and the interaction ends.
But agentic AI is different.
Agentic AI is an autonomous pipeline. You are not chatting with it, you are giving it a goal, like evaluating a potential investment.
And then it just goes off and does it.
The agentic AI breaks that goal down into steps. It decides to go read the financial reports, pull the relevant numbers, open a spreadsheet, build the model, and then send an email with the final recommendation.
It executes tasks independently over an extended period.
Yeah.
And the legal sector is getting hit with this too. Harvey launching Agent Builder for legal workflows. We're talking about automating massive due diligence processes and memo drafting.
This system extracted 20 million legal terms, though they do maintain strict human-in-the-loop checkpoints.
MasterCard is even building what they call a virtual C-suite of AI agents for small and medium enterprises.
A virtual C-suite is a fascinating concept. Imagine an AI acting as a chief financial officer for a small business.
It looks at the cash flow, the upcoming vendor payments, and the historical revenue trends.
And it tells the owner, you are going to run out of money for payroll in 3 weeks unless you delay this specific payment. It provides enterprise-level financial strategy to a 5-person startup.
And at the enterprise level, JP Morgan using AI to validate 550 data points every single night across their payments infrastructure.
They are looking at transaction flows, cross-border payment anomalies, and currency fluctuations.
If humans tried to do that overnight, it would require an absolute army of analysts.
Looking at the sheer volume of these AI deployments across finance and law, what stands out to you the most?
Honestly, genuine skepticism. Wait, so we are trusting AI to just execute complex legal due diligence and run multi-million-dollar investment models while we go grab a coffee?
I know how it sounds.
Which, yeah, is exactly as terrifying as it sounds. We all know these models can hallucinate, Giving them the keys to legally binding contracts and autonomous financial rails feels like a recipe for a spectacular disaster.
Your caution is completely justified, and it actually highlights a growing divide in the business market.
Okay, how so?
There is a massive gap between users who still treat AI as a toy, occasionally asking it trivia questions, and those who are actively building robust, error-checked, AI-driven automation pipelines.
So how are the smart players avoiding the disaster scenario?
The firms integrating this successfully are not just letting the AI run wild.
Right.
They are building incredibly strict guardrails.
Right.
They use secondary AI models to check the work of the primary AI model.
Yeah.
They implement rigid validation checks, and they maintain that human-in-the-loop oversight you mentioned earlier.
So the AI does 90% of the heavy lifting.
The data extraction, the initial drafting, the model building, but the human expert remains at the very end of the funnel to review the output and make the final strategic decision.
It is less about completely replacing the human and more about giving the human an army of tireless, highly efficient interns.
Exactly.
And the amount of capital flowing into building those armies of interns is astronomical. Former Meta Chief Revenue Officer John Hejman and Sequoia partner Ravi Gupta raising $1 billion for a project called Ithaca Holdings.
Their entire strategy is to buy traditional accounting and legal firms and replace their legacy tech with AI.
That is a brilliant and ruthless strategy. They are not trying to sell software to accountants.
No, they are essentially betting that the traditional professional service sector is vastly overstaffed and under-automated.
They want to buy the existing customer relationships and the steady revenue streams, and then swap out the expensive human labor for highly efficient AI pipelines.
The margin expansion on that play is enormous.
And then there's the sovereign wealth level, which operates on an entirely different scale. Abu Dhabi's $237 billion financial platform Judan, led by Sheikh Tahnoon, acquiring a 50.1% stake in AlphaWave Global.
AlphaWave has a $29 billion in assets and massive investments in SpaceX, Anthropic, and OpenAI.
They're using this acquisition to expand AI native life insurance.
This represents a phenomenal consolidation of power and capital. Sovereign wealth funds are looking at the board and realizing that artificial intelligence is no longer just a software category.
It is the new macroeconomic engine.
They're buying the infrastructure of the future economy.
By taking a majority stake in a firm deeply embedded in the leading AI labs, Abu Dhabi is securing its position at the center of the future of automated finance.
They understand that the entities controlling the foundational AI models will ultimately control the financial rails those models operate on.
It is a massive amount to process, but if we pull right back and look at the whole board, the through line here is incredibly clear.
The traditional walls between social media, banking, and artificial intelligence are completely dissolving.
You have neobanks filling out paperwork to become traditional banks. You have traditional exchanges moving their equities onto blockchain.
You have social media apps becoming automated treasuries.
And you have agentic AI being handed the keys to manage all of this newly programmable infrastructure.
The distinction between a technology company and a financial institution is disappearing entirely. They are all converging into autonomous transaction networks.
The user interface might look like a social feed or a chat window, but underneath it is a unified engine of programmable value and autonomous reasoning.
Which is a massive shift in how society functions.
Which leaves us with a genuinely wild question to ponder. If autonomous AI agents start managing our treasury sweeps, negotiating our legal contracts, and executing our trades on always-on blockchains, will the future of finance even need human interfaces?
Or will it just be algorithms negotiating with other algorithms in the dark?
Settling trades at the speed of light while we sit back and hope our spreadsheets are thinking good thoughts about our mortgages.
It is a wild thought.
Something to mull over while you grab that coffee. You have been listening to Vocal Technologist. We have got plenty more complexity to unpack next time, so stay curious.
Spoken Tech for your ears.